Fitch Ratings reports that global growth prospects are weakening as persistent oil shocks squeeze real wages and elevate input costs. While inflation pressure builds, massive AI investments and technology exports are currently the specific factors preventing near-term economic activity from bottoming out. This creates a dangerous divergence. We are tracking a period where explosive, debt-driven tech expansion is occurring simultaneously with a deep structural decay in sovereign debt and global trade networks. South Korea is moving to secure global dominance in AI hardware through a $576 billion industrial push. President Lee Jae-myung's strategy centers on massive new fabrication sites and packaging clusters intended to scale the production of high-bandwidth memory. While the hardware footprint expands, the software ecosystem is tightening. Google has placed strict caps on Meta's access to Gemini AI models, a tactical move to protect proprietary advantages as tech conglomerates race to monetize AI infrastructure. This tech boom is hitting immediate physical limits. In China, the scaling of artificial intelligence data centers and electric vehicle infrastructure has made national energy demand unpredictable. Consumption is consistently outpacing state expectations, forcing a total rethink of resource allocation. The financial foundation is increasingly fragile. A complex corporate debt web now links chip designers, data centers, and hardware suppliers. Because of this heavy leverage, any unexpected slowdown in AI adoption could spark a sharp contraction across tech-heavy debt markets. Persistent inflation is forcing major central banks to pause interest rate cuts. For the world's poorest nations, this environment of high rates and a strong US dollar has pushed nearly half into active debt distress, with service costs starving critical public sectors. The Bank for International Settlements warns that advanced economies face similar risks. Record-high public debt, paired with highly leveraged non-bank financial institutions like hedge funds, now poses a severe threat to global financial stability. In the United Kingdom, sovereign bonds are already experiencing fresh market volatility. Investors are reacting to expansive spending proposals that lack rigid financing frameworks, triggering a rise in 10-year and 30-year gilt yields. Liquidity in primary global bond markets is growing fragile. Stretched valuations have left these markets exposed to sudden price swings. With central banks unable to ease policy, these liquidity gaps ensure that minor economic data surprises will trigger outsized market reactions. Trade tensions are intensifying across the Atlantic. Former President Trump has issued a formal warning to European nations, vowing 100% retaliatory tariffs on imports if domestic taxes on American tech firms are implemented. Simultaneously, commodity shipments in the Pacific are stalled. A commercial deadlock between Australian mining firms and China's centralized buying agency has brought iron ore negotiations to a standstill, disrupting global steelmaking inputs. These transatlantic policy disputes and Pacific commodity deadlocks are actively degrading global shipping efficiency and choking the flow of vital industrial materials. The global economy is operating under extreme tension. Massive capital expenditure for AI is attempting to scale, while being squeezed by persistent inflation, record sovereign debt levels, and fractured supply chains. Operational risk models must now account for frequent bond volatility and potential tech debt contractions. As fiscal buffers are exhausted, governments will find the trade-offs between stimulating growth and managing debt increasingly painful. The current structural reality remains a combination of over-leveraged AI supply chains, fragile poor bond liquidity, and deadlocked global trade networks.